Charlie found one position when he was on the audit committee at Solomon. I think it was mismarked by $20 million. It almost staggers the mind to know the way that position is marked, and you can only come to the conclusion that some trader somehow got influenced whoever did mark it or marked it himself.
Derivatives are dangerous. They have made it almost impossible for investors to understand and analyze our largest commercial banks and investment banks. So my question for you is, how do you analyze and value companies like Bank of America, Merrill Lynch, and other commercial banks that Berkshire has investments in relative to their significant derivative exposures? Thanks.
Yeah, derivatives do complicate the problem very dramatically. Now they are moving away to being collateralized, which helps. But there's no question that if you ask me to describe the derivative position of the B of A, for example, I would know that they have done a conscientious job and worked hard at properly evaluating. But the great danger in derivatives is if there's a discontinuity. If there's not discontinuities, you probably don't have much of a problem, assuming they get marked to market and collateralized and so on. But if the system stops for a while, the system stopped after 9/11 for 3 or 4 days. It stopped at the time of World War I. They closed the New York Stock Exchange for many months. They debated closing the stock exchange very seriously the day after October 19th, 1987. And there were a lot of people that wanted to close it, but and on that Tuesday morning it looked like it was about to stop, but it continued. But if you have a major cyber, nuclear, chemical, biological attack on the country, which will certainly happen at some point, if you have a major discontinuity, then you'll have a lot of problems. But you will also, when things reopen, you will find there can be enormous gaps in things that you thought were fully protected by collateral and that sort of thing, or netting arrangements and that type of thing. So I regard very large derivative positions as dangerous. We inherited a modest-sized position at Gen Re, and in a benign market, we lost about $400 million just in trying to unwind it with no pressure on us whatsoever. So I do think it continues to be a danger to the system.
By the way, the accountants blessed that big derivative position as being worth a lot of money. They were only off, what, many hundreds of millions.
Yeah, well, Charlie found one position when he was on the audit committee at Solomon. I think it was mismarked by $20 million. I actually, by happenstance, I do know of one incredibly mismarked position. Doesn't affect any of our operations, but it almost staggers the mind to know the way that position is marked, and you can only come to the conclusion that some trader somehow got influenced whoever did mark it or marked it himself, heaven forbid, and probably just influenced someone, or they didn't know enough. Some of these things get so complicated they are very hard to evaluate. That's the kind that have the most profit in them usually, so they were quite enthusiastic about those when we were at Solomon. They can be extraordinarily hard to mark, and like I say, I know one that's so mismarked it would blow your mind. And the auditors, I don't think are necessarily capable of holding that behavior in check. It's very interesting because now there's really 4 big auditing firms, and obviously they're auditing companies where there's a derivative position, and they're auditing company A that's on one side of the transaction and they're auditing company B that's on the other side of the transaction. In some cases, it's the same auditor. And I will guarantee you that there's plenty of times when the marks on what they're attesting to are significantly different, which would be an interesting exercise to pursue in terms of checking those numbers out. Derivatives are still dangerous in large quantities, and we would not do them on a collateralized basis because if there was a discontinuity, I don't know exactly where we would end up, and I'm never going to get us in a position where we could have money demanded of us and not be able to fulfill it with ease and with me sleeping well. So we won't engage in it. We've got some in runoff that so far we've made money and had the use of money for a decade or more. I mean, it's been very attractive for us, but that does not entice me at all into doing any derivative transactions that would involve collateral, and collateral is not required. It's still a potential a time bomb in the system. Anything where discontinuities, and basically that means closing up, stopping trading markets from functioning, anything where discontinuities can exist can be real poison in markets. Kuwait, some years ago, went to a very delayed system on settlement of stock purchases so that you didn't have to settle up for 6 months or thereabouts. And it caused all kinds of problems because you've got an IOU from somebody for 6 months, and if you got zillions of those, a lot of trouble can ensue. So I agree with your general caution. I'm not in the least troubled by our Bank of America investment, nor our Wells Fargo. We added to Wells Fargo, and our Bank of America position right now is a preferred stock, but we're very likely to exercise the warrants on that. On the other hand, there are a great number of banks in the world. If you take the 50 largest banks in the world, we wouldn't even think about probably 45 of them. Wouldn't you say that, Charlie?
Well, we're in the awkward position where I think we'll probably make about $20 billion out of derivatives and just those few contracts that you and Ajit did years ago. All that said, we're different from the banks. We would really prefer it if those derivatives had been illegal for us to buy. It would have been better for our country.
Hi, good morning. My name is Gaspar. I'm Spanish and I come from London. I admire you both in many ways, but I would like to know that when looking backwards, what would you have done differently in life in your search for happiness?
Well, I'm 85 and I can't imagine anybody any happier than I am. So by accident or whatever, I'm sitting here eating exactly what I like to eat, doing in life exactly what I love to do with people I love. So it really doesn't get any better than that. And I did decide fairly early in life that my favorite employer was myself, and I think that presented. I've managed to avoid really aggravation of almost any sort. Really, if you or those around you that you love have health problems or something, I mean that is a real tragedy, and there's not much you can do about it except it. But Charlie and I have really been blessed. I mean, here Charlie is 92, 85, and he's doing every day something that he finds fascinating. I think he probably finds what he is doing at 92 as interesting, as fascinating, as rewarding, as socially productive, as any period you could pick in his life. And so we've been extraordinarily lucky. We've been, we're lucky it's a partnership. It's more fun doing things as a partnership. So I've got no complaints. It'd be very churlish of me to have any kind of complaint. And I would say if you're talking about business life, I don't think I would have started with a textile company. Charlie?
Well, looking back, I don't regret that I didn't make more money or become better known or any of those things. I do regret that I didn't wise up as fast as I could have. But there's a blessing in that too. Now that I'm 92, I still have a lot of ignorance left to work on.
Now, we see with the rise of Amazon.com and others a shift from push marketing to pull marketing, from millions of catalogs having been sent out in the past to now consumers searching on what they are looking for. What is your take on how this shift from push to pull marketing will affect our companies?
Well, Norman, the development you refer to is huge. I mean, really huge. And it isn't just Amazon, but Amazon is a huge part of it. And what they've accomplished in a fairly short period of time and continue to accomplish is remarkable. The number of satisfied customers they've developed. And we don't make any decision involving even the manufacturing of goods, the retailing, whatever it is, without thinking long and hard about what the world will look like in 5 or 10 or 20 years with that powerful trend, really hugely powerful trend that you just described. So we don't look at that as something where we're going to try and beat them at their own game. You know, they're better than we are at that. And so Charlie and I are not going to out Bezos by a long shot. But we are going to think about that. It does not worry us, obviously, with the precision cast. But it doesn't worry us in terms of the overwhelming majority of our businesses. But it is a huge economic trend that 20 years ago was not on anybody's radar screen, and lately has been on everybody's radar screen, and many of them have not, and including us in a few areas, have not figured the way to either participate in it or to counter it. The Geico is a good example of a company that, in an industry that had to adjust to change, and some people made the change better than others. We were slow on the internet. The phone had worked so well for us, and this traditional advertising, and the phone had worked so well that there's always a resistance to think about new possibilities. When we saw what was happening on the internet, we jumped in with both feet, and with mobile and whatever. But there are the nature of capitalism is somebody's always trying to figure. If you've got a good business, they're always trying to figure out how to take it away from you and improve on it. And the effect, I would say, just of Amazon, but others that are playing the same game. The effect on industry, the full effect is far from having been seen. I mean, it is a big force, and it already has disrupted plenty of people, and it will disrupt more. I think Berkshire is quite well situated. For one thing, one big advantage we have is we didn't ever see ourselves as starting out in one industry. I mean, we went into department stores, but we didn't think of ourselves as department. We didn't think of ourselves as steel guys or tire guys or anything of that sort. So we've thought of ourselves as having capital to allocate. If you start with a given industry focus and you spend your whole time working on a way to make a better tire or whatever it may be, I think it's hard to have the flexibility of mind that you have if you just think you have a hopefully large and growing pile of capital, and trying to figure out what is the best next move that you can make with that capital. And I think we do have a real advantage that way. But I think the fellow that I think Amazon's got a real advantage too, and this intense focus on having, hundreds of millions of generally very happy customers getting very quick delivery of something that they want to get promptly, and they want to shop the way they shop. And if I owned a bunch of shopping malls or something like that, I would be thinking plenty hard about what they might look like 10 or 20 years from now. Charlie?
Well, I would say that we failed so thoroughly in retailing when we were young that we pretty well avoided the worst troubles when we were old. I think net Berkshire has been helped by the internet. The help at GEICO has been enormous, and it's contributed greatly to the huge increase in market share. And our biggest retailers are so strong that they'll be among the last people to have troubles from Amazon.